high without silver. Silver is part of so much of that application. We also heard, I guess it was a week or so ago, maybe 2 weeks ago, that there's a new battery, an EV battery that charges in 9 minutes and goes 900 kilometers, but it requires about a kilogram of silver. So you're talking about, for every battery, you're talking about 32 ounces. That's going to also increase the demand. And from the supply side, you can just see it in the vaults, all three of them, LBMA, COMEX, and Shanghai. They've just been being drained on a daily basis of physical metal. And that big smash we saw yesterday, that was paper driven. And you can see that because Shanghai, New York was down, what, $7, $8, and Shanghai was barely down $3. So that finally what's happening is the cash markets are coming out in front of the paper markets. The paper markets, the games they've played for the last 50 years, they're coming to an end. The futures price should always be higher than the cash price because of carrying costs and interest. That's called contango. When you get the cash price above the futures price, that's backwardation, and that shows that investors don't want to wait 30 days, 60 days, 90 days for their metal. They want to pay for it today, and they want it today. And now, from an exchange standpoint, as you just pointed out, the physical exchange is trading far above, and that premium is blown out to $7, $8. Yeah, about $7 or $8. The cash market, the cash exchange, is ahead of the two paper exchanges, COMEX and LBMA. That is blatant, outright backwardation. It tells you investors are not willing to wait for their metal. They're not willing to trust that they're going to get their metal. They want it now. 100% believe that this structural shift it's permanent. It's what's going to be, it's the future. Paper contracts are not the future. Paper contracts are dying. And the same could be said for the dollar itself. The dollar is dying, and what's going to supplant that will be some type of BRICS currency that has some type of real backing. And obviously this has been, the BRICS currency been in the works for years and years. And I think wiping away the paper markets being able to price metal, I think wiping away that ability is all part of bringing a backed currency forward that can be trusted.
But are we seeing a similar trend for gold as well?
You're seeing it in a smaller way. The Shanghai premium is much smaller. Understand that, gold has been mined for thousands of years, and pretty much all the gold that was mined is still above ground. It's either in storage form or it's jewelry. It doesn't get used like silver. Silver, when they pull an ounce of silver out of the ground, how many different uses are there for that? You've got solar, you've got medicinal, you have technological, you have jewelry, you have just investors buying it. The silver that has been produced over the last few thousand years largely has already been used. There's not any big stockpiles, whereas gold, there are some very, very large stockpiles, and I think larger stockpiles than are being let on. I think Russia and China both have well more gold than what they're letting on.
As more downward pressure on treasuries, gold, central banks are moving into gold in a big, big way to get out of U.S. treasuries. That trend is going to continue in 2026. It is going to accelerate. More central banks are going to get in on the action, meaning that central banks that haven't been buying gold are going to start. Those that have been buying gold are going to buy more. Now silver has joined the precious metals party. So is platinum. So is palladium. In fact, China recently just announced a ban now on exports of silver. So the supply and demand imbalances are going to continue to move in silver's favor. I think the shorts that are still in this market are still in a lot of trouble. So you have this big precious metals bull market that's now launching into a whole new leg where we're just going to see consistent gains, I think, in gold and silver prices that are going to accelerate as we start to see the US dollar really weaken against its fiat competitors. That's going to put a lot of upward pressure on both consumer prices and long term interest rates in the United States, which is going to pressure the Fed to do something about it, to try to buy those bonds, to try to artificially suppress those rates, interest rates, mortgage rates that would otherwise be going higher. So it's just going to be a print fest and anticipation of the midterms. So it's going to be a weak dollar. It's going to be strong gold and silver prices. Not really sure about the overall U.S. stock market. I think that it won't be a strong year for tech. I think that to the extent that the US stock market does well, it'll be the basic industrials. I think that Dow Jones will outperform the NASDAQ in 2026. But I think the outperformance that we saw in global markets, people that were invested outside the United States, doubled or tripled the returns of the S&P. So I think what we're seeing now in the foreign markets. What happened in 2025 is not the end of something, but the beginning of something. What it's the end of is the outperformance of the US market versus the foreign markets, but it's the beginning of the foreign markets outperforming the US market. Right? It's not a one-off year that is just going to be like, a throwaway, just the exception. This is the new rule. I think we're going to see money flowing out of US dollars and out of US stocks into foreign stocks, just like we're seeing money flow out of dollars and treasuries into gold and now into silver. The central banks aren't buying silver, but I think investors and the public are buying silver. And now this bull market isn't just moving on one leg. In fact, one of the criticisms that it had was that we didn't have the validation from silver. But now we have the validation from silver. And even though gold stocks had a great year, they didn't move up nearly as much as they should have, given the incredible rise in gold and silver. But all of this is going to show up, I think, in a much greater degree in the CPI next year. But I'm going to get to that in a bit. Let me just go back to where I was on silver. So
what makes this silver move different from past cycles is why it's happening. For years, the silver market has been running structural deficits, consuming far more metal than global mining can replace. This isn't new, but what is new is the scale of demand. Silver is no longer just monetary or decorative. It's now essential to the modern economy. Solar panels, electric vehicles, AI infrastructure, advanced electronics, medical technology, all of them rely on silver's unmatched conductivity. And unlike gold, silver doesn't sit idle once mined. It gets used, dispersed, and often lost permanently. That's why most of the silver mined over thousands of years is already gone. This scarcity is now showing up in real time. Physical inventories across major hubs, New York, London, and Shanghai, have been steadily declining. And when silver recently experienced a sharp paper sell-off, the physical markets barely reacted. In some regions, spot silver continued trading at elevated premiums. That divergence is critical. It tells us the physical market is beginning to overpower the paper market. We're seeing signs of backwardation, where buyers are willing to pay more for immediate delivery rather than wait on futures contracts. That only happens when trust in future delivery breaks down. This is exactly what Bill Holter has been warning about. Holter's core message is simple but uncomfortable for the system. Gold and silver are not commodities. They are money. Fiat currencies can be created endlessly through debt and policy. Precious metals cannot. When confidence in paper promises erodes, capital migrates toward assets with no counterparty risk. Peter Schiff connects this directly to the macro picture. He argues that gold and silver are rising because currencies are weakening, not just the dollar, but fiat currencies globally. Exploding deficits, rising debt loads, and central banks trapped between inflation and recession are forcing policymakers to debase currencies to keep the system functioning. That's why central banks have been aggressively buying gold, and why silver is now being pulled higher by investors and industry at the same time. Schiff also stresses that this silver move is not a blow-off top. In past cycles, silver rallied for nearly a decade before peaking. This time, the breakout above $50 wasn't rejected. It was absorbed. Even after a correction from the highs, silver is still holding above $70, suggesting the old resistance level is gone for good. In other words, the correction already happened, and the floor is much higher. That's why both Holter and Schiff see this as a structural repricing, not a temporary spike. As currencies weaken into 2026, and as physical supply tightens further, silver isn't just moving higher, it's being revalued.
What we've seen in the last week doesn't look anything like 1980. So you can't go back and say, yeah, this is another blow off top, just like then, and now silver is going to be in a bear market for 20 years. It's not going to happen, number one. Now, looking at a more recent example of silver having a big move up was 2011 when it almost got to 50. It didn't quite get there. It got up to 47-ish, 48. But that rally also started in the year 2000, 1990. It was another 10-year move. Silver started around $4. So silver went up more than 10x before it had that big surge. Also, the significance of that surge was that it encountered resistance at $50. So it didn't break through the prior high. That's why it pulled back, but it also had a tenfold gain. Now, the most recent rally, if you really want to trace where the rally began, I think it began when silver broke above 30. And so the move from 30 to 80 was not even quite a triple. But more significant, the move didn't stop at the $50 resistance. It paused there, but then it blew through 50 and went all the way up to 84. That is a massive breakout. This is not a blow off top. This is a breakout of huge resistance that goes back to 1980. This is very significant technical action. The fact that we've pulled back to 70 doesn't negate the significance of the breakout above 50. And what I think is even better for people buying silver right now, because if you were looking at $70 silver a couple of weeks ago, people might have been afraid to buy the top. Oh, I don't want to buy 70 because it could go back down to 50. Well, now, if you're buying $70 silver, you're not buying the top. The top was 84. We've had a significant correction in the silver market, and it's still above 70. So the correction is already out of the way. It's not like there's a correction coming. It already came. And in fact, I think now the support for silver is around 70. It's not 50, it's 70. Right? 50 is gone. The opportunity to buy $50 silver doesn't exist anymore.
So this isn't about chasing price. It's about understanding a shift. Silver is breaking free from paper control, gold is being accumulated by central banks, and confidence in fiat money is quietly eroding. That's the message Bill Holter and Peter Schiff are both sending. Now, I want your take. Do you see silver as the next monetary metal to shock the system, or do you think the market is underestimating what's coming? If this analysis helped you see the bigger picture, subscribe so you don't miss what's next. These shifts don't happen often, and when they do, they move fast. I'll see you in the next one.